you mentioned in the blog that you recently wrote on valuations in the COVID era about sort of the multiples that you'd seen coming out of the first sort of 6 months of the pandemic. How useful are they for businesses now? Given that we're still in a similar situation, it is different. There's some things that have changed, things that have stayed the same. How useful are they?
The indices that have come out in the last few months of deals that have actually completed in the COVID era are all suggesting multiples are down roughly by a quarter, 25%. But I guess the question is why, and I think the answer is, well, those deals that have reported data are deals that have happened as opposed to the deals that haven't happened. And if you had a transaction that was already in scope or in plan as COVID was hitting, then for many sellers, it's quite a hard decision to pull out. But for many buyers, they would struggle to justify paying the same amount of same multiple going forward than they did on the historic numbers pre-COVID, because the world has changed. The world is impacted. If nothing else, even if it's not anything to do with your particular business, there is just a general lower level of confidence in the future than there was a year ago. So the deals that have happened are unsurprising that the multiples recorded are lower. But typically when we're doing a valuation today, we're not actually doing a valuation of a deal to be done today. We're doing a valuation of a business, not a transaction in the business. And we are using historic transactions as a way to guide us towards what a multiple would be right now. But in a sense, that's, again, not quite comparing like with like. So when I'm thinking about the multiples point now, I'm more trying to think about the confidence issues and the industry specific issues than the generic multiples coming out of deals that have been done in the last 6 months. So I'll take an example of that. I've just valued a business that manufactures concrete blocks for the construction sector. So they're concrete slabs for flooring, for instance, or staircases. And they actually are seeing growth at the moment because government spending is pointing more towards infrastructure spend and keeping the construction sector going, which is actually one of the first sectors that was unlocked and only really had a very brief closure April, May last year. By 1st of June, most construction was operating normally and actually is busy. So should there be a discount in the multiple for them? I don't think so. In fact, I actually almost think there could be a slight premium to that sector for a while because there's plenty of opportunity for growth. So I guess the point is you've got to think about the individual scenario, not a generic set of data for a wider picture. And the indices that we have that talk about valuation multiples having dropped are generalist in their nature. Typically they are not specific to an individual sector, simply because there won't be that many deals in owner managed businesses, for instance, in the construction sector in the last 6 months. Again, when it comes to multiple data is only as good as the information it's based upon. And unfortunately, again, with the owner managed sector, publicly available data is very imperfect and often quite out of date, whereas the data on which an actual deal is based upon lots of very detailed private data that is undertaken through due diligence and through marketing of a business for sale. And only if you actually get to the underlying data can you actually be kind of more comforted that you're actually working with proper market comparisons. That's one of the reasons we produced over the last 10 years the UK 200 SME Corporate Finance Index, because we know that data comes from the real underlying information that's used to generate the deals in the first place. So it's comparing like with like, as opposed to publicly available unadjusted data with an outcome set out in a deal recorded sometime after the event. So multiples therefore are, specific multiples are slightly dangerous. Long-term trends of multiples are therefore more helpful. And the impact of experience, I suppose, on being not just a valuer but a deal maker, and understanding actually what happens in the marketplace when you're negotiating, when you're watching a potential buyer evaluate a potential target, and what is their approach to that. How does a valuer approach different? How does a purchaser approach different aspects of a target business? And are they willing to pay an excess multiple? If so, why are they willing to pay that excess multiple? And equally, why are they not willing to pay a normal multiple, perhaps? So, I just came off a call just now with one of our clients buying a business at a double-digit multiple, which is very high. Well, why do they do that? Well, I know that particular client has its own multiple for valuation purposes that is even higher than the multiple it's buying at. And in that case, therefore, there is, if nothing else, a simple arbitrage, as there is for most public companies when they buy private companies, in that the multiple applicable to a public company is almost certainly a third to a 50% higher than they would apply to exactly an equivalent private company, simply because of liquidity, and it's easier to trade the shares. So there's an arbitrage for a buyer in those circumstances, that if a quoted company or a large company buyer buys £1 million worth of profit at a 10 times multiple, i.e. they pay £10 million for that, if that £1 million worth of profit is immediately added into the group, the purchaser's group valuation, and the group is worth valued on a 14 times multiple, then just by buying that business at 10 times is already generated 4 million of shareholder value in the buyer group. Yes. By virtue of it's unlikely to impact on the group multiple. In fact, it might even enhance the group multiple a little bit more. But the sellers can't achieve that. So that 4 million growth is simply an arbitrage, because the target business is now part of a wider group. And that's before the target business then thinks about, okay, there might be some synergies here that we can cut out between the two group companies. And that themselves, let's say that increases profits of the combined group by £500,000. Well, that means that actually we've now got a business worth £1.5 million of profits at a 14 times multiple. Well, that actually, if my maths is right, is going to add £11 million worth of value immediately onto maybe another £11 million, yes, or more.